Welcome investors to another video here at FiscalVoyage. My name is Felix. In this video we're going to do a stock analysis on Universal Display Corp. This video was suggested by Junior Stock Investor. Thank you for watching a previous video of mine and commenting and let me know that you wanted me to do a stock analysis of this company. And if you guys have a particular stock you want me to analyze, leave a comment below with the ticker symbol and name and why should I analyze that company. Give me some reasons. But before we get started, if you're new to the channel, make sure to hit that subscribe button and also check out my free ebook that I have a link in the description. It's a 15-page ebook with 5 quick metrics that I look for before I spend more time and hours researching any company. Okay, the stock analysis on Universal Display Corporation, ticker symbol OLED. The company is a developer and manufacturer of organic light emitting diodes, technology and materials, as well as provider of services to the display and lighting industry. It is also an OLED research company. So the company fundamental is outstanding. Revenue grew at a compound rate of 33.1% from 2010 to 2019. Outstanding growth rate there. Net income, for 2010 they had negative net income, so I had to use 2011 to 2019. And as you can see, net income grew at 61.4%. Wow, that's tremendous profit growth there in the last 9 years, so that's outstanding. The company doesn't have a credit rating with S&P, so we'll skip that. Operating income grew at 50.5% in that 9-year period, and earnings grew at the 9-year period from 2011 to 2019 at almost 60% earnings growth. So that's outstanding. This company has been doing great for the past 9 years. So this is the reason the price was growing so much, because of all this high growth rate. And they continue to grow it as well, because revenue 5-year average is 20.7%. So it did drop slightly, about 10% versus their 10-year average, but still high double-digit revenue growth. And net income 5-year average is even better, 74.2% growth for the past 5 years. So that's tremendous, and analysts are expecting higher growth in the next few years, and we'll talk about that shortly in a few slides from here. Earnings 5-year average is 32.76%. So earnings has been going high double digit as well. So that's real great. So you can see this company has been growing quite nicely. So let's continue with fundamentals. For 2019, adjusted earnings came in at $2.92. Net margin is a nice rate of 33.9%, and this is better. This rate was for 2019, and for 2018 the company had net margin of 23.5%. So net margin increased almost 10%. So that's great news there, and so far it's been consistent what I've seen from the last quarter reporting. Return on equity is at 18.3%. This is also an improvement from 2018, and since the company doesn't pay a dividend, so I did some different fundamentals or ratios and things like that here. Price to sell currently is at 20 with a 5-year average of 19.1. Price to sell is basically the current price divided by the total revenue. Sorry, it's actually price divided by sales per shares. You can see here it's right on this 5-year average, so that's something noteworthy, because analysts are expecting much more growth for the future. So we'll talk about that shortly. Enterprise value by earnings before interest and taxes is 48.2 currently versus the 5-year average of 59.3. So this is much better rate than the 5-year average. And enterprise by earnings before interest, tax, depreciation, and amortization is 39.9 versus the 5-year average of 43. So this is very nice, these numbers here. They're high, but that's because the company is growing tremendously. So, but it's lower than the 5-year average, so those are good news there. So I like that. So let's look at the balance sheet, which is outstanding for this company. This is something you don't see with high growth company for the most part. They always use a lot of debt to grow their revenues and such. But this company has a debt to cap of only 1% and a current ratio of 6. So they have very good balance sheet. The debt is very low, with a debt to equity ratio of 0.34, so that's very low considering the high growth. So this company balance sheet looks outstanding. Currently, the price to book ratio is 10.35 versus the 5-year average of 8.3, so it's slightly higher currently than the 5-year average, but it's not too much higher. So let's look at the future outlook for this company. Analysts are expect 2020 earnings to be $2.50. This is lower than the $2.92 that they made in 2019. Of course, with the pandemic, no one's really buying OLEDs equipment and things like that. But they're expected to pick up quite nicely in 2021 at $4.20 versus the 2019 $2.92. So that's real good news there. And analysts are expecting, what I've seen gather around, 25% earnings growth for the next 3 years or even 5 years. So that's outstanding. This is what makes this company attractive right now. My dividend yield return model is actually in par with this analyst. Came in at 24.5% annual rate of return for the foreseeable future. And if we look at the PE, companies like this, you don't necessarily look at PEs because they're so inflated. You would look at price to sales and price to EBITDA and things like that. But I'm just throwing this out here. Currently, the forward PE is 70.9 versus the 5-year PE average of 103. So that, is some undervaluation. But again, it is a high PE. But I'm not really. You don't look for PE with companies that have high growth rate. So I look at the fast graph for OLED. So you can see here, OLED has a 10-year growth of 816%. You can imagine if you bought shares at $20, $30, how much it is now at 185. So that's tremendous growth. The 1 year is negative 9%. The 5-year plus 300%. 6 month at around 4%. So it hasn't grown too much in the year. But this might present an opportunity. So let's look at the fast graph. This is the fast graph for Universal Displays Corp. As you can see here, from 2001 all the way up to 2011 is when 2011 is when they actually made profit at 7 cents a share. But from 2001 all the way to 2010, they had negative earnings. So the price was actually, it was increasing from $10 all the way to what we got here, 16% return. So you still made money if you held on from this time period. But if we take a closer look for the past 9 years, you can see the company has been growing their share price quite nicely. And I'm actually using a custom valuation ratio of 45 because the normal ratio is 57. So I don't think the company is going to grow at that rate of 57, but I think a 45 valuation ratio is nice, considering the high growth rate, 20% plus. But if we look at that, if the company goes to the normal PE ratio of 57, you could see 24% annual rate of return, and it's kind of like the dividend yield return model came in at 24.1% as well. So that's quite interesting there. But if we look at a PE of 45, we can see here you still get a nice annual rate of return of 12.5. But I think the company is going to grow much faster than these rates because nowadays everything has OLED. So this is very interesting stock here. It might drop some. I think since this was the March low, I think this is will be the new base. But I think if shares right now does look attractive, and we'll look at that on the fair price and my recommendation in a few slides. But if we look at the forecasting, the 3 to 5 year growth, you can see very nice growth, 18%, maybe even 21% annual rate of return. So this company is very attractive right now, and it's much lower than the highs. As you can see here, it was up to $224 or in $216 in the beginning of the year, and right now you're not getting at that price. You're getting kind of like half of where that was, or $50 less or so. But that is definitely very attractive right now. We look at the the fair price of my recommendation shortly. Let's look at the fair value now. CFRA does not provide a fair price, but they have a hold recommendation and kind of overweight. Um, how you say recommendation there. Morningstar, however, does have a fair price of 137.56. FastGraph, as we just saw, 189. Yahoo at 175. Since the company doesn't pay any dividend, I don't have a dividend dual return model analyst here. But averaging out the three, we get a fair price of 167.42. Currently, the company goes for $185.02, overvalued by 9.5. Even though the company is overvalued, and as you just saw, the projected growth rate and the high return, this is why I have the company as a buy at current prices. So as you saw, I have a buy recommendation for OLED. The company has been doing tremendous for the past 10 years, as you can see, almost 800% rate of return, or 8 bagger. The main thing I like about this company is the balance sheet. The balance sheet is outstanding. Very low debt. The debt equity ratio is great. The current ratio is great. So the likelihood of this company being bankrupt or not able to pay their debt is very unlikely. And a lot of the analysts are expecting high 20, 25 or even higher earnings growth for the next 3 to 5 years. So that's great. So even though I think it might be fairly valued right now, even if the company drops 10%, I think if you're really interested in this high growth company, I think buying now is a good opening position. Or if you buy it now and it drops 10-15%, buy more, because this company in the next 3 years to 5 years is going to be a lot more. So thank you for watching. And again, if you have a stock that you would like for me to analyze next, leave a comment below with the ticker symbol and why you want me to analyze that. And thank you for watching. If you're new to the channel, make sure to hit that subscribe button, and I'll see you guys in the next video.